Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management, is our co-host. And at 8:30, we will bring you the breaking numbers on retail trade data from Stats Canada with Carl Gomez, Chief Economist and Head of Market Analytics Canada at the Costard Group. And we want to hear from you this morning on First Call. Call us with your questions on stocks, and we'll have Barry answer as many of them as he can. Number to call, 1-855-326-6266. And of course, shares of BlackBerry are falling in pre-market trading. The Canadian software developer posted profit and revenue in its latest quarter that came in above Bay Street expectations, but investors may be focused on the decline in revenue. Sales fell nearly 1.3% compared to the previous year. On the upside, the company raised its full-year earnings outlook, boosted by growth in its QNX division. Lundin Mining has agreed to sell its subsidiary, Lundin Mining US, to Talon Metals. And Lundin's U.S. subsidiary indirectly holds the Eagle Mine and Humboldt Mill, and the deal is valued at about $84 million. Once completed, Lundin will have increased its total holdings in Talon to 20%. The miner says the combination of Talon and Eagle will create a pure-play U.S. nickel company. Shares of Nike are trading sharply lower in the pre-market, down more than 11% after the athletics apparel retailer warned that sales will decline this quarter. Nike now expects revenue to be in the low single digits due to persistent weakness in China. And at its Converse brand, Converse sales plunged 30% in the latest quarter, while Greater China revenue fell 17%. Nike's direct-to-consumer category also disappointed. And now our top line story. A massive new mining project in Ontario is one step closer to becoming a reality, but a trade deal with the U.S. is further away than ever. Abigail Beeman reports.
Thank you so much, everyone.
Ontario and the federal government sign a deal to cut red tape for major projects, including the Ring of Fire.
Today's agreement is the last step in our plan to get shovels in the ground this June.
America's jobs and growth are at stake.
Looks like the two leaders are still on different pages about the Ronald Reagan ad that angered the U.S. president. Watch the prime minister's face and judge for yourself.
Well, number one, that was the best ad that's ever been run. 12.4 billion views. We wanted to bring it to the attention of the American people.
Mark Carney said Canada was close to a deal on sectoral tariffs before the ad.
My judgment is that that is now going to roll into the broader CUSMA negotiations. So we're unlikely, given the time horizons coming together, to have a sectoral agreement. Although, if the United States wants to come back on that in those areas, we're always ready there.
Meanwhile, the United States Trade Representative told lawmakers what the U.S. wants resolved in order to extend CUSMA. Jameson Greer shared remarks from a closed-door meeting targeting a number of things, including Canada's Online Streaming Act and supply management policies that unfairly restrict market access for U.S. dairy products.
We'll continue to protect supply management.
Trade experts say it's good news for Canada that Greer's feedback showed many U.S. stakeholders are supportive of CUSMA.
Sure, we can talk about tweaking on the margin, but ultimately the threats of blowing up the agreement writ large are not what U.S. businesses and U.S. companies would want.
CUSMA top of mind for premiers as well. The Prime Minister held a virtual meeting with them this afternoon. His office tells CTV News the focus was almost entirely on CUSMA and international trade.
And that was CTV's Abigail Beeman. Well, let's bring in our guest co-host, Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. Barry, thanks as always for joining us. Your thoughts first on that reaction from Carney. Does it feel like we're still that Canada strong thing and everybody's still together? You got Ford saying that ad was great and Carney kind of...
I think if you feel the vibes and the sentiment of what's going on, it seems like the rhetoric has calmed down between Canada and the U.S. It seems that make a big splash in the first year, rip things up, try and get your way, and now it seems like they're going to come together. And you can see it obviously. How in the world is the Toronto stock market at an all-time high if we're feeling lousy about Kuzma and worsening trade and tariff stuff that's going to come? So clearly, a lot of smart people think we're moving on to better times here, better relationships with the U.S., better relationships with trade, and all these things that Carney is doing, extremely positive in our opinion.
Now, Carney has said that it looks like the trade talks, Kuzma renegotiation will start in January, and I guess all the tariffs are probably going to be part of that. Is it going to be as a wild a ride as what we saw this year, or will this be a little more civilized, do you think?
No,
of course, Trump is the wild card, but...
Yeah, no chance it will be as wild as it was in 2025. We have midterm elections coming up. It looks like they want to have some sanity going forward, some calmness. Look how well the markets react to stabilization and normalization. So, Trump has said a number of times he wants markets at all-time highs. How do you achieve that? You achieve that by reducing uncertainty. So you have to feel really good about the outlook for trade and relationship negotiations as we head into 2026, in my opinion.
Does it feel like by kind of not trying to resolve some of the... I know people are still getting hit by the tariffs here, but does it feel like by not rushing into trying to find that in some ways, that's actually been better? It's let everybody adjust, and now, do we come from a little bit stronger position when it comes to the negotiations with Kuzma?
I think so. And I think you can, obviously the stock market is the biggest scorecard of what's going on. Like I said, who would have thought the Toronto stock market would be up close to 30% this year, right? And a lot of companies seem to have escaped or managed to adjust to these tariffs, right? Magna at a multi-year high, Bombardier at a multi-year high. How do you explain that? The only way you can explain it is we overreacted to what the worries were in 2025. It turned out to be not as bad as expected. And I think the market obviously is forward-looking. And what it's telling you by being at all-time highs is telling you that the comfort level is very strong as we head into 26.
And are the markets going on the expectation? Because there has been some threats from Trump that, maybe we won't read it. Maybe we'll just throw the whole thing out. Are the markets reacting on the idea that there is going to be a deal eventually?
I think so. I think it's pretty clear based on, why would you be buying some of these stocks at multi-year highs if you thought we'd go right back to the April 2025 Liberation Day tariff negotiations? Anyway, anything can happen. This is what makes markets, of course, but periods of calmness in the market are very, very welcome. We're seeing it. The volatility is just not there.
And from a market and a business point of view, what is the most important thing that Canada needs to maintain in any of these talks? And maybe are there things that you think they could give up and we'd be okay?
Well, I think all we have to do is prove that we are a secure and safe trading partner with significant resources that we can offer to our friendly trading partners. Very exciting, whether it's adding more data centers, building more pipelines, making relationships with other countries in Europe, in Asia. The sky's the limit. We have the assets, we have the people, we have the knowledge. And so, it's got to be so exciting for Canada as we turn the corner here in 26.
And internal, we saw the announcement this week between Canada, Ottawa, and Queen's Park in Ontario, that they were going to try and eliminate some duplicity on various environmental assessments, things like that, to try and open up. Do you think that will have an impact? Is business looking at that going, I think we can work with that?
100%.
Because we've talked about the Ring of Fire for, I don't know how long, 20, 25 years, I think.
Yeah. So, we're now in the situation that we're in because of all the regulatory roadblocks. And of course, I'm not going to tell whether the environmental concerns are right or wrong. It's certainly not my strong point. But the bottom line is we need to have more independence, more control over our assets, and get more trade going. And having a prime minister that understands this is a great step forward.
Okay, we're going to leave it there, but we'll be back in a minute. Up next, we'll take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. We will start with the U.S. futures. cooling inflation, likelihood of further rate cuts are helping this right now, but you can see a bit of a wash right now. Everybody's cautious. Dow, it's a wash. NASDAQ's up by 0.15, and S&P 500 barely up as well. Hardly worth mentioning right now. We'll see what happens when the markets open. Let's see how the Asian markets finish the day. All in the green over there. U.S. data, Bank of Japan rate cut, and tech fueling the rally. You can see the Nikkei up by more than a point. Hang Seng up by 0.75 percentage point, and the CSI 300 up by 0.34%. Heading to Europe, new European data, including weaker than expected UK retail sales and German confidence figures, were weighing on the markets right now. They're pretty much neutral for the most part when you look at those. TSX finished the day up yesterday, 0.61%. Commodities and resources led a rally in Toronto after a weak first half of the week. Let's see who were the movers. NFI Group up by 0.72%. Aritzia, 4.25%. Discovery Silver down 5.45%. And look at Curaleaf off by 32%. Moving over to the metals. Gold is off ever so slightly, but silver continues that march upward. It's been outperforming gold in record territory. Again, all of them are actually in record territory. Look at silver, though, up by more than 1%. And copper's up by almost 2%. And it's in that same area. Rate cuts, industrial demand fueling all that. And looking at oil, Western Canadian Select up slightly yesterday, 0.45%, but still ample supply worldwide. Soft demand is putting some pressure on oil. Let's see what WTI is doing. And it's rallying, strengthening above 56 after hitting 5-year lows earlier this week. Okay, TikTok is reportedly being bought by a group of buyers led by Oracle, with the company and ByteDance signing binding agreements to create a U.S. joint venture, according to reports on an internal TikTok memo. The U.S. joint venture will operate as an independent entity controlling data protection, content moderation, and algorithm security, with a new 7-member majority American board of directors. Now, the deal is expected to close on January 22nd. For more on this, let's bring Barry Schwartz back in. He's the Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. Barry, you like this from an Oracle point of view?
Well, the Americans, kids obviously love this because
they get their
TikTok won't
back.
be shut down. Yeah. So how do we get into this mess? If you look at the relationship between U.S. and China, a lot of U.S. big tech companies are not allowed to operate in China, right? Mm-hmm. Apple has a joint venture, but Google, Netflix, Amazon, they don't operate in China, right? So, tit for tat. How can TikTok be allowed a Chinese?
I guess TikTok for tat, right?
Yeah, exactly. How can it be allowed to operate in the U.S. And has become so popular, like with billions of users? So, and kids love it. So, this deal here is still a work in progress. It looks like a plate of spaghetti, to be honest. You have Oracle owning a chunk, private equity owning a chunk, Abu Dhabi owning a chunk. God only knows.
ByteDance still owning a chunk.
So of course China's still going to retain a half ownership, but this is just TikTok US, of course.
Yeah.
So the bottom line is, I guess it's got to be good for Oracle. We know Oracle is building all these data centers like crazy, hoping that this data will show up. A lot of it relies on OpenAI, but this obviously helps by having the data from TikTok go through its data center. So that's really good news for Oracle. And the stock needs a win because the stock is giving up all its gains for the year. So obviously what we want to see is U.S. big techs eventually being allowed to open up into China and other countries where they're not allowed. So maybe this is a good thing.
Okay, let's talk quickly. Talk about that. Is that likely, though?
No.
Even especially with this right now, it's not going to happen.
No chance. But you never know.
A man can dream, right?
Exactly. There's 1 billion plus customers in China. You'd love to have Google and Netflix have the ability to operate there.
Now, with this in. Is there anything that could derail this deal, or are there lots of things that could derail this deal?
Well, I was reading that the Chinese government has to prove it.
There you go.
So we've got a ways to go. But I think this was obviously telegraphed for a long time, right? We knew that Oracle was going to get involved. There was inklings that Microsoft was going to get involved. Silver Lake, which is a gigantic private equity in the United States and big into tech, is always has its hands in everything. And it's clear that the Saudi Arabians or Abu Dhabi have tons of wealth to invest in these type of media ventures. So it's interesting to us because we own shares of Netflix. Netflix is trying to acquire Warner Brothers. So is Paramount. Larry Ellison's son and family are also involved in the Paramount deal. So all of a sudden, Larry Ellison is like in the news every single where. Yeah.
Where's he coming from? Like, he's 81, still going strong. And is this, I guess, what drives him? And he's just looking for the next deal, or is this kind of a swan song? Or?
Well, he's filthy rich, and
that's an understatement.
And his son is in the business now, and I guess they see the value of media going forward in this age of AI, to own content, to own the distribution. What else could be better than to have billions and billions of customers, whether it's the Warner Brothers content or the TikTok algos?
Now, could the U.S. government have any concerns about this? The fact that ByteDance still has 20%, and then I think ByteDance investors own a percentage as well.
That you'll have to ask a lawyer about that. All I can tell you is this seems to be the deal that everybody wanted. ByteDance is obviously not going to give it away to Microsoft and Oracle. They needed to retain an ownership, so the joint venture is something that makes sense, and it's along the lines of how Apple operates in China.
All right, and can we see anything else coming along down the pipe like this?
Well, you have to see how the Netflix deal plays out. This is the next one, right? So will regulators approve it? How will Ellison, if they're going to raise their bid for Warner Brothers as well? This is an $80+ billion. Where's Ellison going to get all this money? So it's pretty exciting, right? He can't just
sell one or two of his yachts.
Yeah, maybe.
I don't know. Okay, well, we'll see what happens with it. Sounds like 2026 is going to be a busy year.
It always is.
Okay, coming up next, Barry will be back to see why the Canadian trucking industry is on his radar. Time now for On the Radar. We're back with Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. And Barry, you got a couple of Canadian companies on your radar. We're going to get trucking with trucking and TFI International.
The hottest stock on the TSX in December. I think it's up about 25% this month. Of course, you just reminded me that the stock is still down a lot year to date. So,
but that's okay. I mean, if you bought it before,
sorry for my clients.
You bought it before the start of the month.
We've owned it a long time. So the reason why, the TSX record highs, and trucking has obviously been the worst place to be if you're going to have a tariff and trade uncertainty.
Of course, yeah.
But what's happening is the things have changed quickly. The spot freight rates have surged, and there's some political dynamics that are happening in the U.S., of course. U.S. immigration crackdown on a lot of immigrants, and a lot of those people are truck drivers. So there's a shortage now of truck drivers.
Oh, interesting. Okay.
Same is happening in Canada as well. So the bottom line is, all of a sudden, an oversupply has become an undersupply, and that's why we're seeing TFI rally this month. But I'm here to say that there's more to go. TFI, when things were going great, had earned close to $8 US a share in earnings. Since the last year and a half, when pretty much trucking has been in a disaster, TFI has tried to rectify its operations, it's improved operating ratios, it's been buying back stock hand over fist. It's a capital-light business model, so even though this has been one of the worst years for trucking, still very profitable. And so what it's doing with that cash has been buying back stock. And so if this is the true recovery, there's a potential for TFI in the next 12 to 18 months to earn record earnings again.
With all the tariffs and everything that's gone on, and you said TFI, they've got lean. Those are the companies that are going to survive, aren't they? The ones that are coming through this going, we needed to adjust to this. And then when the times are good again, they'll be on the road nicely.
That's why I like to gravitate towards larger companies that have been public for many years, companies that have CEOs and management team that have been in place. Alain Bedard at TFI has been running the helm since, I think, about 2001, 2002. He's been trucking is not a straight line business. No, it's boom and bust.
Yeah.
But what you have to do during bad times is make your business better. And so many companies in Canada improve their balance sheets, their costs because of the worries about tariffs. And then the next step, of course, is implementing AI to improve productivity, routes, logistics, hiring, payments. So the companies that are the largest can afford it. And so that's why we're super excited, though, in TFI.
And can AI have a big impact on that industry?
Absolutely. AI can have a big
I
impact.
mean, we're already talking with drivers. I mean, drivers is obvious one,
Well,
but AI
it's
is
automation and AI
Yeah.
working together. So no question, as the AI improves and there's more software, everybody's looking for their software provider. This is why I'm so bullish on software companies, because we're all looking for our software providers to add AI features that I'll happily pay more for to improve productivity at my shop, for example.
Okay, let's move on to Couche-Tard. It's
Yeah, so this is another so what I picked is two really great compounders on the TSX, but have done nothing this year. And I kind of feel, I was so bullish on the TSX and the market going into this year, but it hasn't translated into as good results as I thought. But there's always next year. Couche-Tard, we all know the 7-Eleven deal didn't happen. So here's what it said. Okay, 7-Eleven not deal happening. Our balance sheet is lean and mean. They've been buying back stock like crazy over the last 2 months. And finally, the results have turned around. This was a company where we were worried about organic sales going negative and staying negative in the U.S., which is its biggest market. The last 2 quarters, they've turned it around. They've added better food items. They've partnered with Guy Fieri. Have you heard of him?
well, yeah. Why am I knowing the name? Okay.
I think it's the Diners, Drives, and Diners.
That's what. Yes.
So
Yeah.
to try and you want people to go into the gas station and maybe buy a hot dog, buy a hamburger, I don't know, a donut, what have you. And so they've improved that as well. And in the meantime, balance sheet is lean and mean. They're able now to make a ton of acquisitions if they want. And the stock valuation, in our opinion, is quite undervalued for a company that has such great returns on invested capital.
And you see them because they would do smaller acquisitions, weren't they, before? And do you see them kind of sticking back to that, or will they make another big try again?
In their latest conference call, they said that their deal book is full and they're looking at deals. This is a company that doesn't like to overpay. They have a very, very smart capital allocation. And so I guess they'll decide whether they want to keep buying back their stock or look for other deals. But no question, the free cash flow is there to continue to grow this business.
Okay, we'll leave it on that note there. And still ahead, we're breaking numbers on retail trade data from Stats Canada with Carl Gomez, Chief Economist and Head of Market Analytics Canada at CoStar Group. And our phone lines will open soon for our first call segment. Call us at 1-855-326-6266. You can send us an email at firstcall@bellmedia.ca. Shares of BlackBerry are falling in pre-market trading, down more than 6% right now. The Canadian software developer posted profit and revenue in its latest quarter that came in above Bay Street expectations, but investors may be focused on the decline in revenue. Sales fell nearly 1.3% compared to the previous year. On the upside, the company raised its full-year earnings outlook, boosted by growth in its QNX division. Lundin Mining has agreed to sell its subsidiary, Lundin Mining US, to Talon Metals. Lundin's U.S. subsidiary indirectly holds the Eagle Mine and Humboldt Mill, and the deal is valued at about $84 million. Once completed, Lundin will have increased its total holdings in Talon to 20%. The miner says the combination of Talon and Eagle will create a pure-play U.S. nickel company. We'll be watching shares of WildBrain today. The Canadian media and production company has agreed to sell its 41% stake in the Peanuts franchise to Sony Music Entertainment and Sony Pictures. The deal is worth $630 million cash. WildBrain says the funds will fuel growth in its wholly owned franchises, including Strawberry Shortcake and Teletubbies, as well as expand its digital network and ad footprint. And looking at the markets right now, it is a mix from a wash on the Dow to NASDAQ 100 up by about 0.2% right now as we head into the Friday, and the S&P 500 a wash on the plus side, though. Stats Canada has just released its retail sales data from October, showing that retail sales decreased 0.2% to $69.4 billion in October. Our next guest says uncertainty in the economy may have dampened consumer spending. However, the numbers could be buoyed by the excitement around the Blue Jays postseason, which may have caused restaurants and bars to be busier than usual. Let's get more from Carl Gomez, Chief Economist and Head of Market Analytics Canada at the CoStar Group. Carl, thanks for joining us.
Great to be here. Thanks very much.
What do you see when you first look at those numbers?
Well, there's some give back here. I mean, definitely the numbers were a little weaker than expected, 0.2%, down 0.2%. Some of the weakness was in categories that have been strong for a little while, like clothing and entertainment, food and beverage sales, things like that. So the numbers are a little weaker than expected. They've come down, but the advanced estimate, which is kind of interesting, for November shows a very strong increase of 1.2%. When we think about what happened in November, the Blue Jays definitely were, heading towards the World Series. So there may be some spending there, but basically, October looked fairly flat, came off of, some weak numbers that were going into the third quarter or fourth quarter. But the pickup in November basically is a great sign for what's to come for holiday shopping.
What was the major drivers, the positive? Was it auto sales? Was it people buying Labubu dolls?
Yeah. Well, it's actually the increase was in motor vehicle sales for sure, building materials, things like that picked up. The declines came mostly in food and beverage retailers. To your point about Labubu dolls, there was some spending that was happening in miscellaneous stores and sporting goods stores. Nothing definitive here in the trends to kind of, say that, one sector is swinging more than the other. But over the long term, what we have been noticing is that discretionary spending, which you would think would actually, show some of the weakness, reflected by the Canadian consumer, has actually held up relatively well. And I expect that the November number is probably reflective of that as well, where discretionary spending on entertainment at bars, Labubu dolls, clothing might actually be picking up to some extent in the November numbers, just as they have been doing for most of the year.
Now, just out of curiosity, do we know what the Blue Jay effect was on any of this? Is there a way to quantify that? And also, is this, with the spending continuing, is that part of the doom spending that you mentioned?
Well, that's the thing. The food and beverage retailers would probably be, to some extent, and I haven't dug into it, just looking at eating establishments and restaurants and entertainment spending. That was down, but, the Blue Jay effect, I think, was really in higher gear at the end of October and in early November. So I think that's probably more or less seen, back in November and maybe reflected in the stronger November numbers that StatsCan did with the flash estimates. The doom spending is an interesting one because, it's resulted in a little bit of choppiness, right now. I mean, I think, most consumer surveys and soft data when it comes to how consumers feel suggests that they're pretty glum. They're dealing with a lot of financial uncertainty. Obviously, we got a trade war. The housing market is fairly weak. Job growth hasn't been all that great. And, Bank of Canada has lowered interest rates, but they basically stopped, lowering rates. There's a lot of reasons why consumers would feel glum. But the interesting thing is consumer spending, especially on those discretionary items, has actually held up quite well. And in our research, what it suggests is perhaps a bit of a demographic shift where, young folks and young people who ordinarily would be saving money for down payments on things like homes are opting to spend their disposable income and whatever they have in excess savings, because there is a bit of savings because people aren't buying homes, on things that make them feel good. And a lot of that has to do with entertainment spending, spending at restaurants, but even things like clothing shopping. And so, the foot traffic, generally speaking, in the retail sector has been quite good. And that's reflective of the strong population growth that we used to have. It's still very strong, but I think that doom spending is something to keep an eye on because I think, for the most part, consumers are not feeling great, but they are going to be spending things to make them feel great.
You almost have 11 months of data for 2025 of retail sales. When we started the year, so much uncertainty. Have the numbers held up better than you expected at the beginning of the year?
Yeah, absolutely. I mean, when we look at what, basically 2025 looks like, it's a healthy increase over 2024 for consumer spending in general. It's been a good chunk of the growth that the Canadian economy managed to put in the first half of the year. So despite, the trade war and tariffs and things, it really has been the consumer that still stayed in the game. I expect that 26 may not be as strong, but definitely 2025 was a surprisingly resilient year for consumer spending.
And what makes you question 2026? What's the concerns?
Well, I think, on a number of fronts, I think, obviously the economy is still very tentative. We have, businesses that aren't, very leaning towards, job growth and things like that. But I think the biggest factor is probably the reduction, and we saw these numbers just recently, that population growth will be coming off. And, if foot traffic it drives retail, and I think a good chunk of 2025 strength is the lagged impact of population growth. Going into 2026, we may, and the latter half of 25, we've already started to see negative population growth. First time in Canada's recorded history that's the case. That is going to be reflected in consumer-dependent segments like retail. I think weaker foot traffic, weaker numbers in population may translate into weaker spending patterns. The other factor, of course, is still, that uncertainty in the economy, how consumers feel. If you don't feel good, you don't want to spend, although, notwithstanding retail therapy, that may be the other factor as well. And probably thirdly is the job market. We haven't seen a lot of growth there, but there is some concern when we look at increased or decreases in job vacancies and things like that as well.
Okay, we're going to have to wrap it up there, Carl, but thanks as always for joining us.
My pleasure. Thanks very much.
Carl Gomez is Chief Economist and Head of Market Analytics Canada at CoStar Group. Still ahead, we will continue to look back on 2025. We're taking a closer look at how the Canadian banks did after this. And, of course, our phone lines are open. Barry Schwartz is taking your questions. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. It's been another banner year for the Canadian banks with fourth quarter beats pretty much across the board as we wrap up 2025. Our guest co-host is ready to give the banks their kudos. Let's welcome back Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. I don't know why I say kudos. Kudo. Isn't that a commercial? It's a commercial, right? That's what it was. It's the advertising words.
I'll give the banks the kudos because it's just been a tremendous year for financials. Obviously, if you believe that the economy or the stock market fell too much, the areas that you want to participate in are financials, right? There's high beta to financials. They tied to stock markets, tied to the good economy, and that's what you're seeing from the banks. All the scenarios, the doom and gloom scenarios, were already priced into the bank stocks. But you have, like we said, they have to give them the kudos, the credit, because their earnings were there. Half the growth of the bank stock prices this year are due to earnings growth, and half is due to multiple expansion. You get multiple expansion because the stock market's doing well. Now the banks are trading at high multiples. The question is this time different? Is now the time that the banks will finally get a more serious multiple? For years and years, banks topped out at around 13 times earnings. That's the most that the Canadian investors would pay for the banks. You wanted your 4% yields, you wanted to pay 13 times earnings. Now the Canadian banks, the dividend yields are under 3, which is, haven't seen that in a long time, and the multiples are high. But why would the Canadian banks deserve a higher multiple? Because they're now more into the fee business. They have more recurring revenue from wealth management, from proprietary trading, from insurance, all these different things that they didn't have 5, 10, 15 years ago. So when you look at the Canadian bank stocks today, they're much better vehicles. And we talked, a few minutes ago about AI. No question, banks are all service-based. TD just had an investor day recently where they talked about all the things that they're trying to implement with AI. The banks have the ability to, everybody in the financial services industry that deals with the banks knows that their technology is from 1972. So the banks have if they can get their act together. That means
a big spend, though, possibly, if they're going to catch up.
It's a big spend, but it will. The banks have nothing else to do with their money. This was a record year for share buyback.
Okay,
They had a record year for share buybacks for the Canadian banks, $15 billion. A lot of it was TD, of course, because they had the money from the Schwab deal. But hey, the banks are swimming in money. It's good times. You got interest rates in the U.S. looks like they're coming down. The inflation number yesterday, if you believe it in the U.S., terrific.
Yeah,
markets at all-time highs. So this party's going to continue until it doesn't.
What might end the party early?
Well, the economy can turn, or there can be more uncertainty with trade and tariffs. We can get a repeat of inflation. No question. We talked about trucking, and all of a sudden we've got a shortage. One of the areas that caused a big problem for inflation in 2022 was, the supply shortage of everything, and all these as a result of the pandemic. So anything can happen to derail the economy. But for now, this is Goldilocks for the banks. And boomers rejoice. Boomers win. They've always said, I've met so many people who say, all I have in my portfolio is 5 banks, and I would laugh at them. They're the ones that are laughing now.
Because they've outperformed. They've for the last 30 years, haven't they? They've outperformed the markets, right?
Double-digit total returns plus a growing dividend each and every year. And it really doesn't seem to matter which bank you chose.
So how do you approach investing in it going into, what if you're a young person, and what do you do going into 2026 with the banks?
With the banks, continue to hold them. They're trading at reasonable valuations. Our favorite bank is National Bank. We've held it for about 20 plus years. I wish I held other Canadian banks longer as well. We've also owned a position on Royal Bank. I like to stick with quality. I like to stick with the well-run banks with the strongest management team that have the most exposure to trading and wealth management, and National and Royal fit the bill for us. Are they like screaming buys right now? Absolutely not. So you want to ease into them here. Like Royal Bank, can't believe $230 a share, gigantic move. So you want to ease into them, and a lot of Canadian stocks have moved up way too much, in our opinion, in 2025.
Do you see any more? Are there any more mergers possible, or acquisitions?
Laurentian Bank is now gone. Canadian Western Bank is now gone. But you would ask the Canadian banks, well, we're facing so much competition from alternative lenders, from fintech, so, let us merge. I don't think it's going to happen. We tried years ago, Royal and BMO tried to merge. That absolutely was stopped. The banks have to continue to grow. I will see them making more wealth management deals, more insurance, more fee-based, and certainly more geographic deals in 2026 because they're swimming in cash.
Okay, we'll take a break there, Barry. Thanks as always. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets. All right, let's take a look at some of the notable analyst calls and recommendations moving the markets today. First up, Wedbush analyst Scott Devitt downgrading Lyft to underperform from neutral and setting a new price target of 16 US, down from 20. The firm believes Lyft is most at risk to the impact of autonomous vehicle disruption, given the company's exposure to the U.S. ride-sharing market and an undiversified offering mix. Following this call, Lyft stocks have fallen in the pre-market. And Nintendo shares fell as much as 2.1% to the lowest since April after Citi lowered the price target for the Japanese video game company to 14,200 yen from 15,800 on the Switch 2 outlook. It's worth noting that shares of the company are the worst performers on the Nikkei 225 on Friday. For more, let's bring in Barry Schwartz, Chief Investment Officer, Portfolio Manager at Baskin Wealth Management.
Nintendo expert.
Are you a Nintendo?
I got a Nintendo for my bar mitzvah when I was 13. That was the greatest present in the world. Yeah, Super Mario. But I'm not buying the stock. I tend to still. I own video games with Activision years ago, and video games is a fashion business. It's very hard. Nintendo obviously has it all locked up, but we try and stay away from those types of businesses.
So nothing aside from did you still have the machine? I bet you do.
Trying to think, maybe in my parents' basement.
Your parents' basement, sure. Right? So, you stay away from any of them have any allure?
No, not at all.
Not at all.
What's the one that's trying to make that GTA Vice City or Red Dead Redemption? Been trying to make it for Take Two for like 6 years, right? Yeah. And so obviously it's very hard to make video games. It's a crapshoot. You don't know if they're going to be successful. You have to get people to buy the devices. The technology comes outdated so quickly, so it's not my type of business.
All right, let's talk about pinball machines. because that's my era. We can invest in pinball machine companies. They're going to make a comeback. And what about Lyft? Some pretty harsh words. Where did I just see the stay away from it? It's just a disaster right now. Most at risk for Lyft. What are your thoughts on that?
Well, you have the current situation where demand is obviously very strong. You see it in the Uber numbers. It's just taking over traffic all across a lot of urban cities. But the bottom line is, what is the future going to look like? Are we going to have self-driving cars? Is Elon Musk going to be able to produce millions of Teslas that self-drive and have a robo-taxi fleet? Lyft just seems too small and too far behind Uber and Tesla and Waymo and all these other big players that it's either got to merge with someone or go away. So I would probably stick with that call and say stay away from the company.
Okay. On that note, we'll leave it there. When we come back, Barry will take your questions on First Call. Time now for a First Call, and it's Robert from Thunder Bay. Robert, what's your question? Hello, Robert? All right. Robert. There you go. Hang on, Robert. We're going to start this one again. Our first caller, Robert from Thunder Bay. Robert, hello. How are you? What's your question?
I'm one of those doubters that think AI is a horrible joke. And related to that, Constellation Software, I think it's probably a good time to pick it up with tax selling season, especially. Okay. What do you think of it?
All right. Thank you, Robert.
Yeah, well, I don't know if people have a lot of tax losses on the stock. Maybe if you bought it earlier this year. And stock obviously has pulled back about 25, 26% year to date. We've owned the shares for a long time. There's no reason for the pullback on the fundamentals, but there's a good reason for the pullback because the architect of the company, Mark Leonard, stepped down for health reasons. That's a big deal.
It is.
It's like Warren Buffett stepping down at age 65 30 years ago, right? So it is a big deal, and there's a good reason for the market to shoot first and ask questions later. But I think the caller is absolutely right about AI in the sense that I don't think it's going to affect Constellation's business. In fact, I think it's going to improve its business. They'll be able to get products to market faster, as well as their customers are looking for AI solutions. So I think they'll look for your software provider has been providing your software for you for decades. So we're pretty excited about buying Constellation Software here. The price has fallen so much that it doesn't have to do very much going forward just to get a pickup. It's already priced as if they're not going to be as aggressive making acquisitions. It's already priced as if there's not going to be as much organic growth. But the last 2 quarters, that's absolutely not been the case. So I think it's a good opportunity. And whether or not tax loss season has played an impact or not, don't care. I plan to own this for a very long time.
Okay. Let's move on to an email. And it says, Season's greetings, Barry. My question is about Rogers Sugar. Is this a real, wait for it, sweet spot for this dividend-paying consumer stock?
Oh, this is one where you'd absolutely own just for the income. I looked quickly. The stock, I think, is up about 5% over the last 5 years. I don't know if sugar demand is probably falling. You can see from the sales of Rogers Sugar that there's not a lot of growth there. This is a tariff business as well. Sugar is not something that is hard to make, and there's a lot of other I guess alternative products. So too small for us. I have no interest in buying companies for the income. I have interest in buying companies that can scale and grow and sell products to billions and billions of customers. And so Rogers Sugar, no opinion here or there, but it's not one that would get me out of bed.
And I guess there's health reasons. A lot of people starting to turn away from sugar.
You see it with alcohol. I mean, the alcohol is down big time. Maybe it's because people are smoking more marijuana. So maybe people smoking marijuana means they want to have more junk food. I don't know. So it goes hand in hand. You don't know. You don't know how these trends are going to play out. But clearly, people are trying to eat healthy. There's Ozempic. There's all those trends, and that can't be good for sugar going forward. I take my coffee with no sugar. It's delicious.
All right. On that note, we're going to move on to an email from Craig. Would you favor U.S. or Canadian banks? I own Citi, which has done very well for a long-term holder. There was a lot of suffering in 2009 which would have lost one a ton of money. Canadian banks seem to avoid the worst of the problems.
Yeah, I lived through the 2008-9 banks when they pulled back. A lot of them recapitalized. They had to do like 1-for-10 splits. All right. And so it's taken decades for some of these U.S. banks like Citigroup and Bank of America just to get back to where they were pre-2008, 2009. Why are they working so well? Hey, the economy's doing great. So that's what banks have picked up. They found religion. The regulatory stuff has really improved their operations. I would obviously stick with JP Morgan if I was to own a U.S. bank here. But the valuations are higher than the Canadian banks. So I'd rather stick with National. I think there's better growth opportunities.
Yeah, JP Morgan is the bank in the States.
It's the absolute gold standard. You know, Roger, I own the stock, and I don't know what came over me when I sold it, but hopefully I won't make those mistakes going forward.
All right. It'll come back maybe one day. Would you pick it up? Have you picked it up again? Or
we haven't because we own other investments and we're happy with them. And I think the valuation's a little high on JP Morgan for what you're getting. But no question, if there was a material pullback, I'd be definitely interested in buying a position again.
Okay. And National and RBC right up here.
Right, those are the two that we own right now.
All right. We'll wrap it up there. Barry, thanks as always for joining us. Happy Hanukkah. It's Hanukkah right now.
It is Happy Hanukkah.
Maybe you'll get Nintendo.
I'm going to eat a lot of latkes and spin the dreidel this weekend. And Merry Christmas. Happy holidays, everybody.
All right.
Thank you
Beautiful.
for having me.
Enjoy. Thanks for joining us, Barry. That is it for us here on The Street. Thank you to Barry Schwartz, for the Chief Investment Officer and Portfolio Manager at Baskin Wealth Management, for joining us today. And he's up next with the Open. And the markets will open in a little more than 30 minutes from now. Have a great day.